I'm absolutely delighted to have Steven Maijoor with us today. He's been a very loyal supporter of our conference, in fact, speaking at each of them over the last few years, but always bringing very good perspectives on securities markets and the ongoing work of ESMA in this area. And I'm sure we will hear very interesting things today. And with Steven, we're also kind of having the third of our 3 ESA chairs over the days, 1 a day, as I realized. And that was also extremely good. So, Steven, it's great to have you with us. I know you're extremely busy, so it's a real honor and pleasure that you're taking out half an hour to speak to us.
Thank you very much, Nick, for that kind introduction. As you say, it's always been good to participate in your fintech conferences. Like the 2 other chairs, Gabriel and Jose Manuel, we've I think you've given us the opportunity to provide the perspectives from the European supervisory authorities, and in my case specifically from ESMA, from a securities markets perspective. So many thanks again for inviting me in the previous years, but also in this year. And what I would like to focus on this time is basically how the pandemic has accelerated the use of digital tools across the economy and what this means for the financial sector. The digital response of the society to the COVID-19 crisis has been really remarkable. Those of us with office jobs now have a style of work unrecognizable from just 12 months ago. This time last year, I was wondering whether it would be practical for ESMA to host our board meetings as a video conference. Chairing the meetings of 27 heads of EU national regulators requires discipline, as we always have a busy agenda. And I must confess to being quite skeptical that we could make video-based meetings a success. The technology seemed an unwelcome distraction. Moreover, our ability to communicate remotely was untested and seemed unnatural. But once circumstances changed, we all adapted. The new pattern of working was rapidly embraced in businesses across the economy. Even many social and family events are now taking place online. Once the danger of the pandemic passes, we will want to get back to meeting in person, I'm sure of that. But we also find that sometimes we want to use the additional flexibility of online working. Some people may find they can improve their work-life balance while maintaining or even improving their productivity. And from a social perspective, family and friends living far apart may become better at keeping in touch. In other words, some of the radical changes in our daily lives bring opportunities, but also challenges. Digital interactions are not always a proper substitute for face-to-face interactions. We know this all too well from recent experience. My remarks today will focus on the accelerated shift to online finance. I will start by describing the long-standing phenomenon of digitalization in the financial sector and how the COVID-19 crisis has acted as a catalyst. In this context, I will highlight some serious risks. And finally, I will suggest how we can address the risks while embracing opportunities. In short, how can we safely navigate this period of accelerated digital transformation? And let me start now first with the risks and opportunities. Digitalization is far from a new phenomenon in finance. The promise of efficiency gains has for decades led firms to digitalize their operations. From back office functions to customer-facing activities, financial services have steadily moved first into a digital format and then online and then into the cloud. In recent years, advanced technologies have proliferated. Consumers can manage their portfolios or bank accounts via smartphone apps. Financial firms are using data analytics and machine learning for a wide range of purposes, including risk management, fraud detection, customer research, and devising new investment strategies. Other technologies play a linking role. Behind the scenes, digital infrastructures are connecting different businesses and different services together. For example, application programming interfaces enable the interoperable use of data. In so doing, they promote the use of technology for regulatory purposes in the form of RegTech. This newfound interoperability is supported by regulatory frameworks and common standards, which ESMA does much promote. The cloud is now a vital infrastructure in many sectors and plays an increasing role in the financial world. DLT also continues to hold promise. Estonia has introduced, for example, a DLT-based digital identity system alongside extensive online provision of state services. Initiatives of this kind reduce paperwork, save citizens time, and make records more accurate. But we're yet to see a killer app for DLT in finance, but given the growing civic and economic applications, it remains a realistic prospect. The opportunities from digitalization are clear. It has the potential to bring faster, cheaper, more transparent, and more efficient financial services to consumers. Digital platforms can provide consumers with ready access to detailed information presented in new, intuitive ways. And for people comfortable with digital technology, it may promote financial inclusion, even if others less inclined to use digital technology may lose out. But the risks too. Despite new modes of presentation, technology may at times reduce transparency. For instance, it can be very hard to explain an algorithm-based investment or lending decision to a consumer. Zooming out, we can see an emerging economic trend towards technology-powered business models that operate across economic sectors. This profound change in market structure, despite potential benefits, raises concerns around privacy and data rights. And furthermore, it may raise risks of concentration. An operational incident that originates in one platform service could have a large impact on other lines of business, including financial services. The COVID-19 crisis has brought existing trends, risks, and opportunities into focus. The cloud is a very good example. Global revenues for public cloud services in general continued an existing upward trend in 2020 at around 25% annual growth. And some key technologies built on cloud platforms have boomed during the crisis. In the first months of 2020, major video conferencing platforms saw user numbers increase many times to facilitate radical changes to how we work, the ones that I've just explained. Daily meeting minutes on one major platform more than doubled between February and April 2020. It was, by the way, WebEx. Overall, the technology sector has been resilient. In the US, the market cap of established technology firms grew over 40% during 2020 versus single-digit growth elsewhere. The crisis has made us much more reliant, not only on certain technologies, but also on the firms that provide them. Even before the crisis, at the start of 2020, the largest 5 big tech firms represented 18% of market cap of the S&P 500. Big techs are now starting to enter finance. China-based firms offer the widest range of services, but there is potential for big tech financial services to grow in Europe and the US, including through partnerships with incumbents. For example, Apple and Goldman Sachs have together launched a credit card. Another example is the DM project from Facebook, which aims to provide an alternative global payment system using DLT. Its scope now appears much more limited than originally planned, but it's still an ambitious and high-profile project. we can expect these huge firms to win market share in the financial sector. Not only have they been bolstered by the crisis, but they enjoy competitive advantages such as vast customer networks and access to cheap funding. While they have different core services, they use the same raw material, key raw material, which is big data. Like smaller big tech firms, they are able to ride on the wave of digitalization. They enjoy digital proximity to clients as people connect to financial services from their screens, reducing the advantage of established branch networks. The tailored services that big tech firms offer based on their customer data can improve the quality for clients. Integrating services across platforms may be convenient for many of us, but it brings also risks, such as around competition. Even if the entry of big techs into certain financial services promotes competition, at first they may grow and become very dominant. Eventually, customers may be reluctant to switch from a firm that provides them with many other online services. In summary, the growing role of technology on the supply side, boosted by the crisis, has major consequences for the financial sector. Let me now turn to changes in demand since the pandemic has hit us. The necessary public health measures in many countries have prompted changes in behavior and has accelerated key consumer trends. According to Deloitte, 35% of consumers have increased their digital banking usage during the pandemic. Visa reports that over 30 million customers in Latin America made their first ever online transaction in the first quarter of 2020 as the pandemic took hold. An important consumer development is the use of online investment tools. Huge bouts of market volatility have spurred online transactions by retail investors able to trade securities via their smartphones. And to learn about this, several of ESMA's competent authorities are analyzing new regulatory data available at national level. A striking early example was the study published last April by the French AMF. Retail client purchases of blue chip equities in France increased fourfold in March 2020, while overall volumes tripled. New client money accounted for up to a fifth of total retail investments. Other competent authorities have similar findings. Data from the Belgian FSMA suggests that the growth in investing was concentrated among young investors. How we evaluate the surge in retail trading depends on what is driving it. Although many households have suffered financially during the pandemic, the overall savings rate has shot up. To the extent that new participation in capital markets is channeling long-term savings, it is a welcome development. But other possibilities are more concerning. There is a risk that much of the new activity is speculative, as retail investors try to profit from market volatility. Equally concerning, they may have turned to day trading to fill in their time during lockdowns. And even worse, as seen in recent headlines, some speculation is fed by online message boards. This can result in mass retail investor trades that create bubble risks. So what is the scale of the risks here for investors? What are the potential abusive practices involved? Together with the national competent authorities, we're closely monitoring these new developments and are assessing whether any further supervisory actions are needed. A related development is a clear concern is the large price bubble that formed in Bitcoin and other crypto assets during the second half of 2020. Although it's hard to establish cause and effect, increased speculation in this area may be linked to increased retail trading of traditional financial instruments. And certainly, it has never been easier to gain exposure to Bitcoin. Some popular apps used for standard financial purposes now also offer crypto asset trading. ESMA and the other ESAs issued warnings around crypto assets in recent years and will remain vigilant in monitoring developments. Would like to highlight one more risk, and it's a serious one. During the pandemic, we have seen an increase in cybersecurity incidents. A recent report by the BIS highlights how hackers have especially targeted the financial sector during the crisis. These cybersecurity incidents highlight a long-term trend. Cyber risks pose a growing threat in terms of their prevalence and sophistication. The potential operational impact on financial services grows with the increasing use of online digital platforms. The title of my speech today refers to safe navigation, alluding to a voyage by sea, a travel by sea. And it's a well-worn metaphor, and I think I've used it before in a speech at the Afore event, but I think it fits the present context very well. Our objectives for the financial sector, such as market integrity, financial stability, and consumer protection, set our desired compass direction. But we face currents in the water which can drag us off course, and we need to move intelligently in this new environment. The existing regulatory framework could not anticipate all the recent technological developments, and this creates challenges for firms and regulators. First, it may be unclear whether and exactly how the existing rules apply to innovative business models and processes. Different interpretations among firms and supervisors may create inconsistencies and fragmentation in the EU. Secondly, some adaptations may be needed to allow the existing rules to be applied effectively, such as when new technologies make certain operating processes redundant, or to address risks introduced by new technologies. And third, firms and authorities face challenges in building the knowledge and expertise they need to address the risks of technology and harness its benefits. The accelerating move to digital finance therefore poses serious questions for policymakers. As new technologies are typically global, we increasingly need to cooperate closely at European and international level. One way we meet this challenge is through the European Forum for Innovation Facilitators, which was launched in 2019 by the ESAs and the European Commission. And we're now working together to strengthen it in line with the digital finance strategy the Commission published last September. At European level, we're increasingly making use of the regulatory data we have available to monitor risks to markets and investors. I observed just now that national competent authorities have been able to study national level MiFIR transaction data to reveal a surge in retail trades in response to the crisis. ESMA's role is to enable the authorities to share not only the underlying data, but also to exchange analyses and to find ways to harmonize their approaches. More generally, we continue to develop our own indicators and analysis in our 6-month report on trends, risks, and vulnerabilities. As well as using data for monitoring, ESMA continues to improve the quality and availability of data in financial markets by helping to develop and promote common reporting standards and identifiers. Our work supports the interoperability of digital tools and is a key enabler of RegTech and SubTech solutions. Interoperability is further supported by mature but evolving regulatory frameworks. In the crypto asset area, building on the 2019 ESMA advice, the European Commission has set out 2 legislative proposals for MiCA and the regulation for a pilot regime for DLT market infrastructures. The 2 proposals form a comprehensive framework for the regulation of crypto assets, and the MiCA proposal intends to address the important risk that unregulated crypto assets pose to investor protection and financial stability. It is particularly timely and relevant considering the current speculation around Bitcoin and recent developments around so-called stablecoins. The DLT pilot regime is especially innovative to the extent that it provides a safe space for market participants and supervisors in the EU to experiment and build expertise around the new technology. As I've observed, financial sector firms are increasingly outsourcing certain operations to the cloud. And at the individual level, it is vital that market participants carry out proper risk management in a proportionate manner. For this reason, ESMA recently published guidelines for outsourcing to cloud service providers. In addition, we as regulators need to be alert to the associated risks at system level in the EU. And finally, I noted that cyber threats continue to increase against the backdrop of the crisis. The Commission has published the Dora legislative proposal, which will impose strict standards on entities across the financial sector. Dora is a vitally important initiative. Building on joint advice to the Commission by the three ESAs in 2019, Dora aims to streamline and strengthen the existing patchwork of relevant provisions across the body of EU financial services legislation. And I warmly welcome its aims and fully echo the call for enhanced collaboration among authorities, both at EU level and internationally. The key part of Dora is to propose new oversight powers for the ESAs regarding third parties providing critical services to financial sector firms. The oversight framework is a difficult balancing act in various respects. A fundamental challenge is that many critical third parties will have, in contrast to the sectoral roles of the ESAs, a cross-sectoral business model with the majority of activities outside of the financial sector. Indeed, there is a case that in an ideal world, oversight would be best carried out by a dedicated, fully resourced, and cross-sectoral EU authority, assessing impacts across the financial sector and beyond. But I fully understand that ideal solutions are not necessarily feasible. Just as we gave detailed advice to the Commission on the early stages of Dora, ESMA will actively support the EU institutions as they refine the proposal, and we will continue to contribute ideas on how to make Dora as effective as possible. Ladies and gentlemen, it is time to conclude. The pandemic and the ensuring public health measures have accelerated the trend towards digital finance. Now more than ever, consumers are managing their finances online and investing online. Firms have rapidly adapted their working practices and business models in response to the crisis and the associated shifts in consumer demands. Business must continue to reinvent themselves, and authorities will need to coordinate their policy response. To remain steadily on course towards our objectives, we must renew our focus on digital finance. Thank you very much for your attention.
Stephen, thank you very much for this very clear and succinct presentation of some of the challenges post-COVID. I know you've got time for just a few minutes for 2 or 3 questions. Just to the audience, if you want to ask Stephen a question related to this, please let us know. But let me start off. I think one of the interesting things in the ESA reviews, so the revision to the underlying rules, which came into force at the beginning of last year, was to strengthen your mandate in the space of digital applications and innovation. How do you balance, because you highlight quite rightly the importance of supervisory convergence and best practice, and you have in previous conferences, but where do you see the balance between the ability of individual markets or jurisdictions to be innovative, to be specializing in particular areas, smaller markets in Europe, for example, and this overlaying supervisory coordination and cooperation at the European level? Where's the tension between harmonization and innovation in the supervisory structure?
Thank you very much, Nick, for that question. I must say that in my view is that where the key element is in terms of allowing innovation and allowing innovation, let's say, in possibly smaller markets, more local markets, is that the key for me is in the proportionality of the legislation itself and what, for example, are the requirements for starting businesses. I think it will be difficult to make the argument is that for innovation to happen, it would be favorable to have different regulatory requirements across the member states, because we can see is that many innovations, although they might be relatively modest in size, the chances that there is, let's say, a cross-border element is quite significant, because precisely, of course, language can play an important role, but with the whole movement towards a digital environment, I think the national markets play a less important role. Language is still important. On the other hand, there will be very quickly a demand to offer a product also across borders to consumers or to businesses across boundaries, across national boundaries. So I think where for me the key element, it is more in the proportionality per se that we apply in the legislation to allow, let's say, smaller businesses to start, is to not only, let's say, be favorable to and to be careful to be favorable towards the larger players, much less so that I think it would be favorable to have local regulations and requirements. So I think that will be the key there.
You mentioned one other interesting proposal that's on the table at the moment, the pilot project, which kind of, however you want to call it, I wouldn't call it light touch, but which kind of allows supervisors, NCAs, national competent authorities, to disapply certain elements of MiFID around MTFs, multilateral trading facilities, or in the CSD space. I think it's the first time I've seen this type of a model. Normally we create a new framework like crowdfunding or PSD to take a core piece of legislation like MiFID or the CSDR and disapply certain elements. Where do you see the opportunity of this type of an approach for stimulating technological change and new entrants, maybe even beyond MiFID, the current applications in MiFID and the CSDR?
Well, it's indeed it's an interesting piece of legislation, because there is a bit this suggestion that you can disapply EU law, and to some extent it is true, is that some of the requirements that apply to regular MTFs and regular settlement systems may not apply, or you can opt to not apply and go for alternative arrangements instead. But of course, there is a description what should be the requirement in a case when the regular applications from an MTF or a settlement system when they do not apply. I think what we need to do is we need to just go across pieces of legislation and monitor new technologies and see how existing regulatory requirements may be creating tensions for new innovation. And that was also precisely the reason for making this, let's say, pilot regime applicable to MTFs and settlement systems. One of the pieces of advice that we had given was that, especially for DLT, the existing settlement requirements may not fit very well. And so that was, I assume, also the reason for the Commission to come with a proposal to precisely give an alternative treatment for settlement in the case of DLT. And so I think what we need to do is you need to monitor new technological developments. In general, of course, you want to have legislation which is technology neutral, but if you still see that there's going to be tension, I think that may be a requirement or a reason to adjust the applicable and the existing legislation.
Maybe let me close on one question, which is taking us to the international dimension or the third country dimension. With technology, of course, it becomes much easier for investors or providers to cross borders, both within the EU, in which case it facilitates the single market, but also from other jurisdictions. How is ESMA responding to this? I've seen your comments around reverse solicitation, for example, and concerns that come with that. How do you see ESMA responding to those challenges? And what role can international cooperation in IOSCO and other bodies play to help with such potential tensions?
Well, I think first of all, what is important to realize, although It is true that because of technology, is that the actual physical place where people are sitting, or where servers are, or where staff is, it becomes less relevant. And we're having this conference here while everybody stays at his own location, and that is clear. But that, of course, doesn't take away that there needs to be clarity on what is the regulatory framework applies. Despite all the progress with technology, and which makes it so much easier to bring together, assets, people that are working in different places, there still needs to be clarity on what is the regulatory framework that applies. Is it a transaction? Is it a marketing action that is captured by, let's say, EU law, or is it captured by the requirements of third countries? And it's very important to be precise of that, because that ultimately determines issues like investor protection. They can affect stability, and it's therefore important that we need to be clear what is subject to EU law, and also to ensure a level playing field for activities within the EU environment. And so that was one of the reasons why we issued a statement on reverse solicitation. Of course, providers from other third countries, they can participate in the European capital market, but it's important that they do it against the same standards as their competitors from the EU. And so that was the reason for issuing that specific statement on reverse solicitation. Of course, coordination continues to be very important. We have our regular dialogue with the UK, and as you will imagine, it's the most intensive dialogues that we have with third countries. That is continuing, also considering now, irrespective of the new status of the UK. But it is important that we continue this coordination. Our markets are interconnected, and therefore we need to do that. At the same time, there is the reality is that legislation and supervision is ultimately jurisdiction-based. And so that is the reason why actions like the one that we have done was important.
Steven, with that, a big thank you for a very clear speech. Yes, very good to hear, and we've heard it separately, the very close cooperation you still have with the UK, of course. It's very close to us. Also, thank you for your support over the last few years. And I say that at the end of each session, I hope to see you in person. But I think in your case, it would be nice to see you in person at our next conference in whatever capacity that might be. But thank you very much for today and for the clarity of how you set things out. Thank you so much.
Thank you very much, Nick. You wouldn't imagine that, but I miss Brussels. I miss being in Brussels. So I'm looking forward to meeting you there in person again.